In early March 2026, BlackRock triggered a mechanism most investors had never heard of. The world's largest asset manager, managing over $10 trillion in assets, blocked nearly half of all withdrawal requests from its $26 billion HPS lending private credit fund. According to Bloomberg's confirmed reporting, the fund's quarterly redemption gate was activated. A quarterly redemption gate is a legal provision buried in private fund documents. It allows fund managers to limit or suspend investor withdrawals when requests exceed the fund's available liquid assets. It is not fraud. It is not insolvency. It is a legal mechanism that was designed into the product from the beginning. And it was triggered because too many investors tried to exit at the same time. That is the confirmed, sourced, documented starting point of this analysis. This was not an isolated event at a single institution. Blackstone, one of the world's largest alternative asset managers, simultaneously faced $3.8 billion in withdrawal requests, representing 7.9% of assets in its private credit fund. To meet those requests, Blackstone was forced to raise $400 million from its own balance sheet and from its own senior leadership personally. Cliffwater's $33 billion flagship private credit fund faced shareholders seeking to withdraw 7% of total stakes at the same time. Morgan Stanley received repurchase requests representing 10.9% of shares in its North Haven private income fund. Moody's, one of the three major credit rating agencies, downgraded a KKR private credit fund to junk status, citing a 5.5% non-performing loan rate. According to Fortune magazine, $265 billion in private credit assets are now either gated or facing active redemption pressure across the industry. That $265 billion is not a loss figure. It is the confirmed total of assets and funds where investors are currently attempting to exit and are being told in legal terms that they cannot. The names behind these funds are not obscure regional firms. BlackRock, Blackstone, Morgan Stanley, Cliffwater, KKR. These are the institutions that manage retirement accounts for pension funds, university endowments, and individual investors across the country. Before explaining why this matters beyond the private credit sector itself, one structural distinction requires explicit clarification. A bank deposit, a checking account, a savings account, a certificate of deposit at an FDIC member institution is protected up to $250,000 per depositor per institution by the Federal Deposit Insurance Corporation. That protection has applied since the FDIC was created, and the $250,000 limit has been in place since 2010. A private credit fund investment is not a bank deposit. It is an investment product. It has no FDIC protection of any kind. When a quarterly redemption gate is triggered on a private credit fund, the FDIC does not intervene. No federal guarantee applies. The investor's ability to access their money depends entirely on what the fund's legal documents permit. This distinction matters because private credit has been marketed as a stable, income-generating alternative to traditional fixed income for the past 15 years. University endowments embedded it. State pension funds allocated to it. Wealth management platforms packaged it for individual investors seeking consistent returns. Many of those investors may not have fully read the redemption gate provisions in the fund documents they signed. This is the structural exposure the confirmed March 2026 events have made undeniable. The private credit industry's growth and its current stress each have a documented timeline. After 2008, the Federal Reserve cut interest rates to near zero and held them there for years. Traditional fixed income investments yielded almost nothing. Investors, institutions, and pension funds were desperate for returns. Private credit, the practice of large asset managers lending directly to companies outside public bond markets, offered returns of 8%, 10%, and 12% annually. Unlike public equity markets, private credit did not show daily price volatility. It appeared to be the ideal low-risk, high-return alternative in a zero-rate environment. By the time the inflow cycle peaked, private credit had grown into a global industry managing nearly $2 trillion in assets, according to industry data. That is stage one of a pattern that financial history documents precisely. Massive capital inflows, extraordinary apparent stability, and universal institutional adoption. Stage two is where the stress accumulated beneath the surface. As competitive pressure to deploy capital grew, lending standards across the private credit industry declined progressively. A metric called payment-in-kind lending became a key indicator of that deterioration. In a payment-in-kind loan, a borrower does not pay cash interest. Instead, unpaid interest is added to the principal balance, compounding the debt rather than servicing it. By 2025, payment-in-kind loans had reached 8% of the entire private credit market, double the level recorded in 2019, according to Bloomberg and industry data. When a meaningful portion of borrowers in a portfolio cannot pay the interest on what they owe, the portfolio is not generating healthy returns. It is deferring deterioration that will eventually have to be recognized. Those loans were being carried at full face value on the books of every major private credit fund. Then, in January 2026, Bloomberg reported that a BlackRock private debt fund fell the most in nearly 6 years after disclosing write-downs across troubled investments. The fund waived some of its own fees, a move that signals internal pressure that asset managers only publicly acknowledge when it becomes undeniable. In early March 2026, Bloomberg further confirmed that BlackRock had marked the value of a private loan from 100 cents on the dollar to zero in approximately 3 months, from full face value in September 2025 to worthless by December 2025. A loan that moved from full value to zero in 90 days was not experiencing normal credit deterioration. It was reflecting a valuation that the market had already known for some time. 3 historical patterns define why the confirmed March 2026 private credit events carry structural significance beyond the asset class itself. The first is Black Monday, October 19, 1987. The Dow Jones Industrial Average fell 22.6% in a single trading session. Over $500 billion in market value was erased before the closing bell. The mechanism was portfolio insurance, a sophisticated financial product that had been widely adopted by institutional investors as protection against significant losses. The product worked by automatically triggering stock sales as prices declined. Every major institution held the same product. When prices began to fall on the morning of October 19th, the automatic selling systems activated across the board simultaneously. One institution's hedge became every institution's tripwire. The feedback loop accelerated beyond any human ability to stop it in real time. The mechanism sold as protection became the weapon that destroyed 22.6% of market value in less than 7 hours. The parallel to private credit in 2026 is structural, not speculative. Every major private credit fund holds similar redemption gate provisions. When institutional investors began requesting withdrawals simultaneously across BlackRock, Blackstone, Morgan Stanley, Cliffwater, and KKR at the same time, the synchronized nature of those requests is the same architecture that portfolio insurance created in 1987. Different instrument, same underlying dynamic. The second historical case is Lehman Brothers, September 2008. Lehman was the 4th largest investment bank in the United States, managing over $600 billion in assets. Confirmed by the court-appointed bankruptcy examiner's report, Lehman had been using an accounting mechanism called Repo 105 to temporarily move tens of billions of dollars in debt off its balance sheet before each quarterly reporting deadline. The practice allowed the bank to present leverage ratios that were dramatically lower than actual leverage. The bank appeared healthier than it was. When the housing market deteriorated seriously in 2007 and 2008, the hidden positions became impossible to conceal. Lehman filed for bankruptcy on September 15, 2008. The impact was not proportional to Lehman's size, it was exponential. Overnight lending between banks froze almost entirely. Money market funds broke the dollar. Commercial paper markets seized. Corporations across every sector lost access to short-term financing needed to make payroll. The lesson is not simply that one institution was reckless. The lesson is that opacity in financial instruments, leverage concealed behind apparent stability, and the sudden recognition that assets are worth far less than they have been marked. These conditions produce damage that radiates outward and does not stop at the institution that fails first. Private credit funds marking loans at face value that have since been written to zero share the structural characteristic that defined Lehman's final quarters. The third historical case is Cyprus in 2013. Cypriot banks had massively over-leveraged into Greek sovereign debt. When Greece restructured its debt obligations, Cypriot banks lost billions. The Cypriot government could not absorb the losses without destroying national finances. The European Union and International Monetary Fund made a decision that has permanently altered regulatory frameworks globally. They implemented a bail-in rather than a bailout. Cypriot banks were closed for 2 consecutive weeks. When they reopened, accounts holding over $100,000 had approximately 47.5% of everything above that threshold forcibly converted into equity shares of a bank that was already effectively worthless. This was legal under the resolution framework applied. This is not a warning about what might happen to standard bank deposits in the United States under normal conditions. It is a documented example of what deposit resolution can look like under extreme institutional stress. Following Cyprus, the bail-in framework was formally incorporated into regulatory architecture globally. In the United States, Dodd-Frank Title II created the Orderly Liquidation Authority, which gives regulators the legal mechanism to resolve failing financial institutions by imposing losses on creditors and counterparties rather than exclusively on taxpayers. The EU Bank Recovery and Resolution Directive codified similar frameworks across Europe. These are confirmed, publicly available regulatory instruments. They exist because policymakers recognized after 2008 that the capacity for unlimited taxpayer bailouts has structural limits. The concurrent market data amplifies the significance of the private credit stress. The Shiller KP ratio, the cyclically adjusted price-to-earnings measure, stood at approximately 39 as of early 2026, according to Financer.com data. That is the second highest reading in over 100 years of market history. The only time it was higher was in 2000 at the peak of the dot-com bubble, when it reached 44 before the S&P 500 lost 49% of its value over the following 2 years. The S&P 500 has fallen approximately 7% year-to-date as of late March 2026, according to CNN Business. The Nasdaq has entered correction territory, down more than 10% from its peak. The financial sector has lost 13.3% from its January 6th peak, according to reported market data. Technical analysts note the sector is approaching a pattern called a death cross, a signal that professional traders monitor as an indicator of sustained further decline. Moody's recession probability model stood at 49% as of late March 2026, as reported by the Motley Fool. In every historical instance, this model has crossed 50%. A recession has followed within 12 months. Mark Zandi, Moody's chief economist, stated publicly, "If oil prices remain elevated for more than a few weeks, a recession will be difficult to avoid." Goldman Sachs published a bear market scenario for the S&P 500 at 5,400, representing approximately a 23% decline from the January 2026 peak of 6,179. JP Morgan cut its year-end S&P 500 target to 7,200. The Bank of America Fund Manager Survey confirmed that institutional cash allocations jumped from a record low of 3.2% in January to 4.3% by March 2026, the fastest institutional shift to cash since the COVID-19 crisis. Growth optimism among fund managers collapsed from roughly 40% in January to just 7% by March. Inflation fears surged from 9% to 45% in the same period. Fund managers are not moving to cash at pandemic-level speed because their public statements suggest optimism. They are moving to cash because their private positioning reflects a different assessment of conditions. The banking sector data adds a separate layer of documented stress. On January 31st, 2026, Metropolitan Capital Bank and Trust in Chicago became the first confirmed U.S. bank failure of 2026. Illinois regulators closed the bank, citing unsafe and unsound conditions with an impaired capital position. The FDIC estimated its loss to the Deposit Insurance Fund at $19.7 million. The bank held $261 million in total assets. There were 2 bank failures in all of 2025. The first failure of 2026 arrived before January was over. For context, Silicon Valley Bank collapsed in March 2023 after $42 billion in deposits were withdrawn in a single 24-hour period, the fastest bank run in American history at the time. Before that run began, SVB was consistently described as contained, stable, and manageable by observers not watching the specific deposit composition data. Stanford University economists, in published research by Zhang, Matfos, and colleagues, documented that the U.S. banking system's fragility to uninsured depositor runs could involve hundreds of banks simultaneously given the interest rate environment and unrealized loss concentrations. The FDIC reported approximately $477 billion in unrealized losses across the U.S. banking system as of late 2023. The high interest rate environment since that report has continued to pressure bank balance sheets. The FDIC Deposit Insurance Fund covers approximately 1.3% of total insured deposits in the system, a finite pool designed for isolated, not synchronized, institutional failures. This data does not mean a banking crisis is imminent. It means the confirmed structural vulnerabilities documented by named researchers and regulatory agencies are real, measurable, and relevant to the current environment. 4 specific data-grounded actions follow from this analysis. The first is understanding exactly what legal structure holds each portion of your savings and investments. FDIC insurance covers bank deposits up to $250,000 per depositor per institution at FDIC member banks. It does not cover investment funds, brokerage accounts above SIPC limits, private credit fund positions, or any alternative investment vehicle. If any portion of your savings or retirement assets is in a private credit fund, a non-traded REIT, or any similar alternative investment, locate the fund's legal documents and identify the redemption gate provision. It is there in every such product. It is legal, and it can be triggered the moment withdrawal requests exceed the fund's available liquid assets. The second is tracking the specific dates and data releases most relevant to current conditions. The BCA research projection, confirmed by CNBC on March 28th, identifies mid-April as the period when physical oil supply losses may double as IEA emergency releases approach their effective limits. The Moody's recession probability model at 49% is one data point from its 100% historical threshold. Any shift in Federal Reserve language acknowledging the inflation versus recession conflict explicitly would represent a change in the current monetary policy lock. The third is understanding the difference between volatility and structural repricing. A 7% decline from a peak is within the historical range of normal market correction. It is also consistent with the documented early stage of the 1973 episode, the one that ultimately produced a 44% decline, where multiple relief rallies occurred inside a larger structural repricing that took 11 months to complete. The question the data raises is whether current conditions, CAPE at 39, monetary policy locked, private credit under structural pressure, recession model at 49%, represent a normal correction or the early stages of a structural repricing. The fourth is recognizing what institutional money is communicating through its actual portfolio positioning rather than its public statements. The same institutions, whose public commentary remains measured, are privately shifting to cash at the fastest rate since the COVID-19 pandemic, according to the BOFA Fund Manager Survey. The divergence between public statements and private positioning has a documented name in market cycle analysis: distribution. It describes the phase when institutional money repositions before broader repricing becomes visible to retail participants.